Thanks to everyone at SEK for inviting me to present today. I'm Matt Conlin. I work for PFM Asset Management. So PFM is an institutional investment advisor, and we primarily work with local governments. I'm based out of Harrisburg, Pennsylvania, and but PFM is a nationwide company. So you might know me best from the Pennsylvania Local Government Investment Trust. I support the central part of PA for Pliget. PFM is the investment advisor and administrator for Pliget. So PFM manages 17 other local government investment pools like Pliget throughout the country. And beyond that, we also serve as an outsourced chief investment officer to local governments for longer term assets like pensions or OPEB funds. And I work with clients mostly in Pennsylvania, but I go all over the mid-Atlantic part of the country, so anywhere from PA to around North Carolina. So that's my intro, and I'll get started on the presentation now. What I'm going to be covering today is, as you can see, a fixed income market update. It's going to be a lot of talk about the Fed, and I'm going to break the theme you'll hear throughout it is the consumer and how the recent market developments and the economy has impacted the consumer and what that's going to mean for things coming up or what we think that'll mean. So follow along and hope you enjoy it. I don't know if there's a chance to submit questions, but hopefully you can jot down my email, which is on this page here. And if you have any questions, feel free to reach out. I'm going to start with a labor market update. So I mentioned the Fed. The Fed has two mandates, keeping a fully employed workforce in the United States and keeping stable prices. So we're going to first start with looking at the labor market and inflation. So you can see since 2022, the last 4 years, the unemployment rate has been climbing, but you can see on the scale, we're only looking between 4 and 5%. Where the unemployment rate's been over the last 4 years. So that is what's defined as a fully employed workforce. Everyone that wants to work is essentially working right now. You can see it has come down a little bit here in 2026. That's mainly due to people leaving the workforce. So if you look at the labor force participation rate on the right chart, you'll see that since the year 2000, the labor force participation rate has come down from around 67% to where it's at today, below 62%. And especially in 2026, we've seen a decline. The larger trend is an aging workforce, so baby boomers retiring. It's also a trend of younger workers taking their time getting into the workforce. It's also technology, kind of taking the place of workers and a number of other factors. But that has led to the unemployment rate kind of staying steady and coming down a little bit, even though new job openings aren't quite as strong as a real fully healthy job market. So that's kind of the story on the unemployment rate right now. And there we go. So moving on here, job openings versus unemployed workers is an interesting story. So if you go back 4 years coming out of the pandemic, there were 2 job openings at one point for every one unemployed person. So at the time, if you were unemployed, you had a variety of options. If you were employed and just looking to move, you had options. And there was a time where you can make a significant increase to your salary by just changing jobs. That has sort of gone away. We're more at a 1-to-1 ratio right now for job openings versus unemployed workers. And then you can see on the right, the monthly change in non-farm payrolls. Those numbers have been softer than the last few years, but still holding steady enough to keep that unemployment rate, low, and sometimes beating expectations, sometimes coming in under expectations, but overall nothing that worries economists too much. The Fed had been paying attention to the job market real closely as inflation had been coming down in the last couple of years. They wanted to make sure that, as they got prices under control, that the job market also stayed healthy. So again, what all these numbers we've looked at so far are saying is that the overall job market is healthy it's maybe not the strongest it's ever been, but it's also not collapsing. Here's a look at what's making up those new jobs. Again, they're called non-farm payrolls. That's the statistics that we look at. That's because agricultural jobs are left out of that calculation as they're very seasonal. So they would just throw off the way the new jobs looked. There's some other types of jobs that are not included in the calculation, like self-employed people and some others. But what's making up the largest portion of new jobs are healthcare and education jobs, government jobs, professional business services. What's detracting from new jobs? Leisure and hospitality. So just interesting to look at the components that make up non-farm payrolls. Some more data on the job market. The labor force participation rate, which we looked at a few slides ago, this is now just a look at the last 10 years instead of the last 25 years. And you can see that overall, it's been volatile, but it hasn't changed that much for the last 10 years. But you can see that the recent trend here in 2026 is that the participation rate is back on the decline without having any major market disruption like COVID in 2020, where you can see that major drop to the participation rate. The other chart I wanted to point out on this slide is in the top right, average hourly earnings. Again, sort of not looking at COVID there because we all kind of know the story there. But starting in 2022, coming out of the pandemic, when you could change jobs and get a raise, average hourly earnings were up. Inflation was also up, and we'll look at that as well. But since 2022, average hourly earnings, year over year increases are down. So as inflation's starting to tick up now this year, and average hourly earnings have been declining year over year for the last couple of years, consumers are starting to feel their purchasing power eroding. So leaving consumers feeling not as great about the economy as maybe they did, a few years ago. And we'll look at that a little more closely later. Here's a look at wage growth compared directly to inflation. So you can see coming out, or starting in the middle of COVID, coming out of it in 2022, inflation exceeded wage growth. Inflation was over 9%. Wage growth was also doing well, but not keeping up with inflation. Then there was a flip-flop. So for the last 3 years, wage growth has exceeded inflation as inflation's come down, but you don't really ever make up, that 9% inflation. Prices are still elevated. There was no deflation, so prices haven't come down. They just aren't growing as fast as they were. But if you look at just the most recent last few months here in 2026, there's been a flip-flop again where inflation is now growing at a faster rate than wages. Oh, are we stopping here for a polling question, or should I just keep going?
You can just keep going. Thank you.
All right, sounds great. So now we're going to move into inflation. So we're looking at the consumer price index, the price that consumers pay for goods. The story here was the Fed had rates elevated coming out of COVID because of inflation being extremely high. They wanted to get a handle on that. If you take a look at CPI, it's come down since 2023, and the Fed's goal was to get inflation down to 2%. That's where they like to see inflation. Never quite got there. Got very close, but never quite got there. But they were making progress, and they felt that things were going in the right direction. So they started to lower their Fed funds rate. And I will talk about Fed funds rate in more detail later. But then what happened, as you probably all know, here in 2026, the war in Iran started. The Strait of Hormuz was closed, cutting off 20% of the global oil supply, which drove up inflation and drove up CPI. So you can see that is up above 4.2% as of May. And the question was, what would the higher oil prices do to everyday goods? And if you look at core CPI, the yellow line is a inflation reading that strips out energy and food. which tend to be more volatile. So you can see that lagged normal CPI, which does include food and energy, but is also on the rise now. So those higher energy and oil prices are now impacting everyday goods. Here's the producer price index. So CPI is the prices that consumers pay for goods. Producer price index is the price that businesses and producers pay for their inventory and their supplies to make the goods. Same story, came down out of COVID, back on the rise here in 2026 at a 6.5% rate. This can be a leading indicator. So if businesses are paying more for their inventories and their supplies, oftentimes they pass that on to the consumer. It does tend to lag, as it is right now, with the higher transportation costs, oil prices. In the short term, I think businesses didn't pass that on to consumers immediately. You don't want to lose customers over what potentially could be short term. Now this has gone on long enough that they are starting to pass those costs on to consumers. And the big question is, how long can the U.S. economy withstand those higher prices? Will consumers continue to spend their money? And you can see the components that make up the producer price index on the right. But on the next slide, this is just another look at CPI. So on the chart on the right, you can see the components that make up that number. Energy largely is what's creating the higher increase right now. But sort of across the board, all the components are up except for used cars and trucks. So it's just something to keep note of. If you are in the market for a used car or truck, that's one area where prices are actually down year over year. All right. So I mentioned, higher oil prices. Here's a look at those prices here. What's often referred to the most is the Brent crude oil price in the bottom right. But the story was, the Iran war started, Strait of Hormuz was closed, and oil prices shot up to, above $100 a barrel, close to $110 a barrel. The initial thought was that it's 100% closed, nothing's getting through. Then there was a peace deal put in place. I don't remember the date at this point, but the markets felt good. Strait of Hormuz was back open. Prices came down. That peace deal is now, no longer in place, and the strait is essentially closed again. But markets have sort of realized that closed doesn't mean 100% closed. There are still ships getting through. There's oil getting through. It's just getting through at a slower pace and at much higher cost. So this chart kind of ends before the most recent developments, which oil's prices are back up. I think they're in the $80 to $90 per barrel range now, but not as drastically as they were in the beginning of the war. Before I move on, I'll just kind of talk about how the markets tend to react more emotionally at first. So, but overall, this war in Iran and the disruption to the oil supply is looked at more temporary, even though it's tough on our wallets. But as an overall, what it's doing to the economy, investors, economists are looking at this as more short-term in nature, and that the U.S. consumer can, for now, handle this and can continue to make the purchases that they need to make. So we looked at inflation, job market. Let's look at some other data points here. Housing market. So the U.S. 30-year mortgage rate between 6% and 7% for the last couple of years. For new home buyers, that doesn't feel great. We've been very accustomed to low mortgage rates since essentially 2010, coming out of the Great Recession. Historically, this mortgage rate cycle that we're in right now is really not that high. Rates have been higher. I know for a first-time home buyer that's not easy to hear, but it has come down a little bit, back up again in 2026 because of the thought that rates are going to be a little higher for longer. We can also look at the National Home Price Index. You can see that the year-over-year increase to home prices has come down. So home prices haven't come down, but the year-over-year increases have come down over the last 2 years. Again, for a first-time home buyer, not great. All these charts here, these statistics show maybe a slightly improving housing market, not booming, but also not collapsing. I mentioned the consumer a few times. I'll continue to. So the growth of the U.S. economy, GDP, has largely been made up of the consumer and what we buy on a daily basis. So you can see how retail sales on a monthly basis has just continued to climb over the last 4 years. And you can see the components on the right that's making up that increase. So because the consumer makes up such a large part of the U.S. economy, again, the big question is how long can the consumer withstand the higher prices and the rising inflation at the same time that average hourly wages are coming down year over year. It's the big question in the economy. Now, most economists don't see a recession coming. PFM doesn't see a big chance of a recession coming, but kind of all economists are in agreement that the economy is going to be a little bit slower for a little while longer. On this slide, a little bit more about the consumer. Just take a look at on the right, personal savings as a percent of disposable income. The story during COVID was that no one was going out and spending money. There was stimulus coming in. The consumer had built up savings. And then coming out of COVID, as everyone's getting back out spending money and prices are higher due to inflation, the consumers have gone through their savings and have much less savings as a percent of their disposable income. So consumers are spending, they continue to, but if there was some kind of shock to the economy, there's not as much in the bank to hold the consumer over. Another statistic that kind of speaks to that is, in the top right, the credit card balances in the U.S. continue to climb over the last 4 years. The chart in the bottom left, personal savings rate compared to inflation. That chart looks a lot like the average hourly earnings compared to inflation. So personal savings people were increasing their savings, at a higher rate than inflation for the last few years, and it's flip-flopped in 2026. So all these things don't sound great, but it's what economists look at, even though some of the headline numbers look okay and the economy's overall doing well. The U.S. economy is strong. There are some signs that things could slow the economy down or continue to be a slower economy. The University of Michigan polls consumers on a regular basis to get how they're feeling about the economy. So the consumer sentiment index on the left shows that over the last 3 years, again, it's been volatile, but consumers are feeling less and less great about the economy. There's been a little uptick in 2026, and that's just the, potential end to the Iran war. But a reading below 50, which is where it's at right now, is not a great reading. The consumer does not feel good about the economy, even though there are many signs that the economy is doing well. And if you look at the stock market, it continues to go up, and I'll show that at the end. But the consumer themselves don't feel great. And on the right, this is where consumers feel prices will be in 1 year. So we saw CPIs at 4.2%. The consumer feels that prices a year from now will be closer to 5% higher than they are today. And it's sort of a self-fulfilling prophecy, because if a consumer thinks that something they want or need today is going to be 5% higher next year, they might just buy more now, and they might be willing to pay a higher price for that good today, which in turn would ultimately raise prices. So just an interesting thing to look at about how the consumer is feeling. Moving on to GDP. So I've mentioned the consumer, and how they make up a large part of U.S. GDP. They are the dark blue block in this bar chart. So 6 of the last 8 quarters, the consumer made up the largest part of GDP growth. The more recently, the first quarter of 2026, the consumer was not the largest part of GDP. It was actually fixed investment. Fixed investment is, especially that quarter, was a lot of technology investment and AI investment, data centers. So the theme now for second half of 2026 and beyond, as you probably all know, is, what is that technology investment going to continue to be made? Will it help to keep the U.S. economy going? And what's the return on that investment? Another interesting thing about GDP over the last 2 years were the 2 quarters in 2025, the first quarter and second quarter. So you can see GDP was down by 0.6% in the first quarter of 2025. And the reason was that was when the tariff talk started. So the official tariff announcement wasn't made until the beginning of the second quarter. But in the first quarter, businesses kind of saw it coming. So they made a lot of their imports and purchases in the first quarter. Imports are a negative to GDP, so brought it down. That's the green part of the GDP bar chart you see there. Then in the second quarter, businesses largely made their imports and made their purchases. Their inventory were full, so net exports were positive, making GDP up 3.8%. So it's really not a good gauge of where GDP was in those 2 quarters, but you can kind of guess that it's somewhere in the middle of those. The other interesting one is the fourth quarter of 2025. You can see the negative portion of GDP was government expenditures. We had a long government shutdown in 2025, and then when the government opened back up in the late part of the quarter, into the first quarter, all those purchases that weren't being made by the government in the fourth quarter were done in the first quarter of 2026. So just kind of interesting things to look at. Moving on, I'm going to start talking about the Fed a little bit here. So the Federal Reserve has a new chairperson, Kevin Warsh. Over the last year or so, there's been a lot of talk about how the previous chair, Jerome Powell, his term was ending in 2026, and that meant that President Trump would be able to appoint the new Fed chair. And what would that Fed chair do once he got in place? And the thought was that they would reduce the Fed funds rate in spite of inflation, in spite of where prices were, reduce the Fed funds rate because that's what the president wanted. It helps spur the economy on. Well, that hasn't come to pass now that Kevin Warsh is the Fed chair. What his big focus has been on, first of all, he's been saying that rates will be higher for longer. They're not going to make any decisions right now because they're going to just wait and see how the economy is doing. Inflation's up. Reducing rates right now would only make inflation go higher. What he is interested in is changing their communication style and not being so forward-looking that the Fed has been. The Fed has been trying to be very transparent over the last few years. And not that Kevin Warsh feels that they want to be any less transparent. He just doesn't see the value in kind of projecting forward very far because so much can change. So the Fed releases these summary of economic projections, SEPs, and I think they will continue to get these. There just might be less emphasis put on it. But this is just a look at the Fed's projections of GDP, inflation, unemployment rate, and federal funds rate over the next few years. And it's just comparing their March projections to their June projections. So what I want to point out here is that inflation on the bottom left, you can see that the Fed projects that inflation will be higher this year and then come back down to more normal and hopefully closer to 2% in the long run. The other thing that's changed between March and June projections from the Fed is that you can see that they now are projecting Fed funds rate to be a little bit higher for longer. So if you pay attention to this kind of news, you probably hear that term a lot. And I've already said it a few times, higher for longer. That's a good thing for local government investment yields on your overnight funds. Not a great thing if you're looking to borrow money, but for investments, it's fine. U.S. Treasury yield curve. I wanted to show this here because as local governments, what you can invest in is high quality fixed income securities. The U.S. Treasury is considered the risk-free investment option, and so it's important to kind of always know where the U.S. Treasury yield curve is, because that kind of dictates where fixed income rates are for high quality fixed income investments that you guys can invest in. The part that I really want to focus on here today is the 1 year range. So that's the shaded part. That shows where the U.S. Treasury yield curve has been over the last 1 year. And you can see at one point it was inverted, meaning overnight rates, the rates all the way on the left-hand side of the chart, were higher than 1 to 2 to 3 year rates. That was because the anticipation from the market was that the Fed was going to continue to reduce rates, which did happen in 2024 and 2025. And there was expectation that would happen again in 2026. It didn't happen, and it likely will not now because of the Iran war. So we have a positively sloped yield curve. If you invest money out farther than overnight, you should expect to get a higher rate of return on those investments. So think CDs, think Pliget term, if you're familiar with Pliget term, any other sort of fixed rate investment beyond what's sitting overnight. I'll just do this real quick. 2 year Treasury compared to the 10-year. Really, why we look at this. The 10 years a good kind of barometer to use is where are rates going? Where does the market think rates are going in the future? It's also sometimes to compare the two, a look at is there a recession coming? When it's inverted, meaning the 2 year yields are higher than the 10-year yields like they were in 2024, sometimes that's a sign of a recession coming. Not the case in this the last few years. It was all a factor of the Fed raised rates so dramatically high so quickly in 2022 to combat inflation that the markets knew the Fed was going to have to reduce overnight rates at some point in the near future. So this is just looking that there wasn't inversion. There's not anymore. And we're kind of more in a normal yield curve environment. Again, this is look at the U.S. Treasury yield curve, not a 1 year look, but just looking back to the very end of 2025. That's the dotted line. So you can see even at the very end of 2025, there was still an expectation the rates were going to come down this year. That has completely flip-flopped, and rates are even higher today than they were in June of this year. So I tell you that if you do have the capacity to invest out farther, it's a great time to look at that. There is expectations from the market that the Fed could raise rates. We don't necessarily think at this point that the Fed will, and I'll talk about that in a couple slides. Well, in this slide. So this is a look at the last 5 years of the Fed and their overnight lending rate. This is very important for local governments. This directly impacts what you can earn on your overnight funds. The current Fed funds rate, it's always a range. The current Fed funds rate is 350 to 375. So your overnight money, your liquid money, should be earning somewhere in that general range. Like I said, if you go back to the very beginning of 2026, the expectation was that the Fed was going to continue to reduce their Fed funds rate. That hasn't happened because of the Iran war and because inflation's back up higher. Now, Fed funds futures, which are investors essentially betting on where the Fed funds rate will be, is projecting 1 to 2 rate increases by the end of this year. We don't think that's going to happen because the Fed increasing the Fed funds rate doesn't help the global oil supply, which is what's causing the inflation right now. Now, the longer this goes on, the higher prices get because of that. There could be a case to be made that the Fed needs to increase rates. But we think it's a good buying opportunity for short-term fixed income. So, 1 to 2 years maximum for local government operating funds, because you can get paid for investing out farther if your cash flows, can support it, and you're comfortable with it. But there is an opportunity there. The other chart on here is the assets of the Federal Reserve. So they have their Fed funds rate, which is their main tool to affect monetary policy. Since 2008, they also use their balance sheet, so their ability to buy securities, as a tool. They can buy treasuries, mortgage-backed securities, federal agency securities to lower longer-term rates. So this doesn't affect overnight rates like the Fed funds rate. It affects longer-term rates. This is one tool that Kevin Warsh has created a committee to review if it's still should be a primary tool for the Fed to use for monetary policy, because it is sort of a forward-looking or a tool that will affect things in the future. And it seems that the new chair, Warsh, wants to be less forward-looking and just look at data today and what can the Fed do to impact things today. The Fed also releases this dot plot, which is the 19 voting members of the Fed and where they think the Fed funds rate should be now, next year, and going forward. This is one area where, again, Kevin Warsh wants to look at if it's worth continuing to submit this information. So I said there's 19 voting members of the Fed. There are 18 dots on this chart because Kevin Warsh has not submitted his dot where he thinks Fed funds should be. But for today, so just going forward, if you've seen this chart before, this might be going away. Or again, if it does continue, there just might be less emphasis put on it. But as investors, we like to see what the Fed's just generally thinking. And if you were to go back a year or two, where Fed thought the Fed funds rate should be going forward would have looked lower. You can see that in March, where the average line is, which is the gray line, and then in June where it is, which is the blue line. So overall, Fed funds will likely come down, all else being equal in the next few years, but it's going to be higher than previously thought. All right. With the last few minutes that I have, I just thought I'd touch on the equity markets. So as local governments, you can invest your operating reserve bond proceeds in stocks, but your pensions, OPEB, and other long-term funds that sit outside of local government investment code can, obviously, and you might all have retirement accounts that hopefully are invested in the stock market. Over the last 2 years and for a while now, the stock market's been nothing but up. There have been a few blips in there. You can see in 2025 when the market was down because of tariffs and sort of the uncertainty of what that would do for the global economy. And then here in 2026, the war in Iran. Both events were absorbed by investors and by the markets, and ultimately stocks continued to go up because with everything that I've talked about, public companies have great earnings and great earnings potential. There's a lot of optimism around technology and AI. So the markets are up. Now, this hasn't really helped how the consumer feels, and it's sort of the theme of the U.S. economy right now is where the people with money who, are greatly impacted by stocks going up, they're happy. But then there's the lower earners who, so what, the stock market's up. What does that do for me today and meeting my needs? This last slide here is just a look at different indexes and their year-to-date returns. Again, all doing very well. The Barclays U.S. aggregate, that's just fixed income returns. But everything else is equities, domestic stocks, and international. And you can see across the board, great returns for year to date so far. So again, I think the theme is the U.S. economy is strong. There are some signs that it's weakening. There's signs that consumers aren't happy. If they can continue to spend and inflation comes down and wages improve, things should be looking good. AI investment's going to be a big unknown, and how that return on that investment comes in will be big for the U.S. economy. And that's kind of what I have. So again, I don't know if there's questions, but feel free to reach out if you have any questions for me. Thank you.